Hi, everyone. This is our update for December 17, episode 320, and the last show of 2024. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy, and lucky last, Tim Denoyer from ACT Research. He's our last special guest of the year. Welcome, Tim. Great to have you on the show as always.
Thanks for having me, Dean.
Yeah, good. Chad, how's things?
Yeah, things are great. It's exciting to wrap up the year here with Tim. We've had a strong cast the last few episodes, so this is a great finish to the year.
Yeah, we've had some pretty heavy hitters on the show in the last month. We started with Anthony Smith, then we had Zach Rogers, we had Jason Miller, Ken Adamo last week, and Tim Denoyer. So December's turning to be quite the month for forecasting what next year will look like. Interesting to revisit this time next year, Tim, see how we did.
We'll try to fill those big shoes today.
All right. Tim, for those that don't know you, tell us a little bit more about what you do and including the cash report that you write.
Sure. Yeah, thanks. I'm VP Senior Analyst at ACT Research. We are a commercial vehicle research analysis and forecasting firm. My job is specifically freight forecasting and forecasting freight volumes and rates around the industry. And I also write the cash report on a monthly basis, analyzing those indexes and providing a little bit of forecasting in that report too.
Great. All right, good. Well, we'll dive into the market update and bring you back a little bit later. And then I'll do the market update on the spot market side, and then Chad will talk about the contract market. And then we'll dive into what you think this year is going to end like and what we think next year will start like. So let's start with some of the key trends we're watching. I've got a fair bit on the spot market during my market update. Rates are performing pretty much as we'd expect, maintaining a margin against last year in the order of 8 to 10 cents a mile. So they're behaving pretty much as we'd expect this time of the year. Reefer rates cooling a little bit, but then they'll take off fairly aggressively once we get to the gap between Christmas and New Year. November imports are out last week, down again for the second month, but still at a record high for November, 20% higher than the monthly average for November going back to 2015. And that even includes the pandemic impacted months of 2020, 2021, and 2022. So some extraordinary import volumes. Jason Miller's was on the show last week. His ton-mile index came out last week, showing that freight demand is showing signs of lifting off the bottom after three successive months of gains. It was the first time in 8 months that his ton-mile index was flat year over year after a number of declines. Tim's Cass shipment report out. Import index showed a gain of about 0.5% in November. We'll talk to Tim about that a little bit later in the show. And again, Class 8 truck orders, Tim will touch on that. Class 8 truck orders, I'll use the word, I think FreightWaves used the word stumble. Tim, I'll let you dig a bit deeper into these numbers. I'm not sure if it was a stumble or just something unusual when you look at the numbers seasonally. This week's market update, they'll be out this evening. We're looking at trucking in India, where we have a large office at DAT. We'll also cover some of the news on the PMI, also look at some of the freight demand out of the French freight capital of the world in Othello, Washington, and of course, what flatbed carriers can expect from the latest LMI, Logistics Managers Index. So let's start off with load-to-truck ratio and dry van. Load posts decreased last week, still 24% higher than last year. This is sort of the second to last full shipping week of the year, so we're expecting a little bit of a surge in volumes this year. Carrier equipment posts were down last week. So the load-to-truck ratio was up to about 5.74, much stronger than this time last year, almost double last year's load-to-truck ratio. If you recall, it was about 3.05. In refrigerated, compared to last year's pre-Christmas shipping surge, load post volumes were about 15% higher last week and about 6% lower than the long-term average for week 50. So we're seeing some healthy spot market volumes for refrigerated. Load-to-truck ratio stood at 6.73 last week. Compared to this time last year, it was 3.70, so not quite double. And in flatbed, national load postings were down last week, but remained about 13% higher than last year. Equipment posts were down also compared to last year as carriers have exited the industry. Load-to-truck load-to-truck ratio in flatbed ended last week roughly the same as the week prior at 15.30. This time last year, week 50 was 8.29. So very healthy load-to-truck ratio numbers reported last week. And in a year-over-year look at spot rates, there was a noticeable surge in volume of loads moving last week. Again, that's fairly normal for shippers moving freight into destination markets. Volumes were up 24% compared to the prior week, about 18% higher year-over-year. That's on the loads moved side. There was a tightening of capacity, as we've just spoken about with the exodus of capacity this year. Rates were up about 2 cents a mile last week. National average ended the week at $1.74. It's about 9 cents a mile higher than last year and about 6 cents per mile lower than 2022. In the reefer market, rates cooled last week, again, as we forecast, down about 4 cents a mile to a national average of $2.01. At that level, reefer line haul rates are about 9 cents a mile higher than last year and about 7 cents a mile lower than the 3-month trailing average. And lastly, in flatbed, line haul rates increased by 2 cents a mile last week. The national average was just under $2 at $1.99 per mile. Remember, these are excluding fuel, so line haul only. Flatbed line haul rates are about 9 cents a mile higher than last year and sitting about 6 cents a mile lower than in 2022, and just a penny per mile lower than the 3-month trailing average. So a lot of consistency in the flatbed market. And over to the short-term forecasts. These are our short-term 35-day forecast using our flagship RateCast product. That's in green. That's predicting what rate view is going to be 35 days out. Of course, it heavily weights longer-term seasonal trends. And you can see there with the yellow and red, they're the upper and lower forward-looking error bands. The blue is the rolling 7-day weighted average of historical rates for loads moved over 550 miles. So let's dive into the forecast. Not a lot of change from last week. Now we're starting to see the impact of the tightening of capacity during the Christmas and New Year break that we typically see every year. So the charts look very similar across the 3 equipment types. And in dry van, RateCast is looking for a 2 cent per mile increase out to the 18th of January, ending at about $1.78 at the forecast range end. Low case scenario has rates down 5 cents a mile in the middle of January, high case scenario up 10. In the next 2 weeks, rates are forecast to rise 10 cents a mile. That's the green line. That's exactly the same as last year's actual rate increase over the same period. This year, RateCast thinks rates will peak at about $1.84 on January 4. That's right before we get the first full shipping week of 2025. And then, of course, we typically see rates cool off after that. In refrigerated, RateCast is thinking rates will be up about 10 cents a mile out to January 18, ending at about 227 at that time frame. On 1/4, that's when they think they'll peak at that level. Low case scenario has rates up 3 cents a mile. High case scenario has rates up 16 cents a mile in the reefer market. Reefer is expecting a 25 cent per mile surge in rates in the next 2 weeks. Last year, reefer rates increased by 20 cents a mile over the same 2-week period. A lot of those gains, though, came in the period between Christmas and New Year. So RateCast is expecting much the same market behavior as this time last year. And in flatbed, RateCast is thinking rates will be up 4 cents a mile out to the 3rd week of January. Low case scenario has rates down 2 cents a mile. High case scenario has rates up 9 cents a mile. RateCast is thinking rates will end at about 203 per mile, up from where they are now. And rates are sitting where they think they'll be at 204. That's about 8 cents a mile higher compared to this time last year by the time we get into the start of the new year. So that's the look at the spot market short-term forecast. Over to Chad for a quick look at the contract market.
Yep. Thanks, Dean. So I'll cover everything from a shipper to carrier or broker perspective. Starting out with dry van, the 3 graphs here, spot premium ratio at the top. This is the difference between spot rates and contract rates. Currently, spot rates about -8% below contract rates. The more interesting trend right now is the new rate differential. You can see that bouncing around +1%. I looked at the data behind it. So this is a weekly graph going back to 2016. New rate differential measures the difference between new rates that are repeating, so new contract rates, compared to the rates that they replaced. So we can see that in the data, so we measure that. So this is basically the yield from shippers' contract bids. And we're seeing that positive. And on 8/18, we started to see positive new rate differential. Since then, we've had 15 of the last 17 weeks as a positive result, and 11, and we've been on a run now of 11 positive weeks of new rate differential. So we're starting to see shippers consistently take positive rate increases. On the whole, what we're hearing from shippers is that it's a mixed bag when they run an RFP right now. They're getting a mix of some lanes increases, some lanes decreases, but all small changes. And of course, that's always going to change depending on which shipper you are and what your starting position is. And so all those positive numbers are just right around 1 or just less than 1. So only 4 of the weeks have been more than 1% new rate differential or new rate increases from contract bids. You can see the contract rate index there hanging pretty flat. So these new rates coming in aren't really moving that quite yet. That's good 80% plus of the data. The new rate differential is somewhere around 10% of the data, depending on any given week. And that spot premium ratio is around 17% of the data that we have in our data set. Moving on to reefer. Reefer rates, spot premium ratio is still negative in its current state at 2.3% negative. Spot rates 2.3% below contract rates. We see a nice improvement there on new rate differential, 1.9% positive first week of December. We'll see if that continues as a trend, and contract rate index still remaining flat. And then finally, the last graph here where we're showing rate per mile by the 3 different modes of dry van, temp control, and flatbed, or equipment types rather. We can see that that temp control there in the middle, that spot rate, really chasing up close to the contract rate. So maybe crossing over. I think this is probably a seasonal thing as we look at that spot forecast that Dean just showed. We expect this to come back down, which makes sense with Thanksgiving and Christmas and New Year's holidays. So we'll keep a close eye on this and see how it plays out over the next few weeks. That's a wrap on contract rates.
All right. Okay. Thank you, Chad. Tim, let's bring you back in. Of course, our long-term forecasts are a little bit pessimistic. I mean, we're thinking about spot rates in particular. It's very different to Chad's shipper to carrier and broker buy side. This is sort of broker to carrier spot market side, not looking at much more than single-digit rate increases over the next year. So love to get your take on what you think the market's going to do, what the state of the economy is going into next year, and what some of the challenges we may be facing.
Was that single digit? Was that a spot number or a contract?
Spot.
Yeah. I think I would agree. I think our forecasts are pretty similar. I think there's a lot going on. There's certainly a lot of upside risks that we can kind of talk through, but I would be, very consistent based on just sort of this ongoing capacity additions that we're seeing from private fleets, and that's to go back to your earlier point about truck orders. They got off to a slow start, is how I would suggest describing order season so far. But that makes a whole lot of sense in an election year where typically order books open up around September, and you see some significant order activity in the September-October timeframe. But in an election year, I don't think people wanted to make decisions until November or maybe even beyond. And we did get a look at preliminary November orders. We don't have the tractor splits yet, but the overall November number was a very strong number. It was 37,000 for North America Class 8, and that suggests that there's going to be some ongoing capacity additions in general. The vocational markets have been pretty strong, but this one does look like it was a bit more tractor focused, and so that suggests that anyone expecting the markets to be off to the races in a big way is probably going to be disappointed. I think in 2025. Who could be suggesting something like that? But I think those kind of predictions that things would be off to the races, like they have in recent cycles, have been consistently wrong for, well, in large part that reason of not only the resilience of owner operators, but the private fleet capacity additions that continue to weigh on for-hire demand. To bring it back to the CAS index, we did get a pretty decent result in November. It was up almost 3% month to month in seasonally adjusted terms. But I mean, the actual increase month to month was considerably smaller. It was just 0.5%. But usually, going into November, some of that might have been the Thanksgiving timing, to be honest. But anyway, we're still down about 1% year over year, just a little bit less than 1% year over year. So even though we see significant increases in a number of parts of the freight economy, imports are up a lot, intermodal volumes are up a lot. These things that we can, cross-border volumes are up considerably. We can see general growth in freight, but it's not hitting the for-hire sector in a bigger way, in our view, because of these capacity additions, and that's why we do like to focus a lot on the supply side.
Tim, do you look at data on the trailer orders as well? Are they doing anything different than trucks, or are they in line with each other?
They are pretty similar. I mean, they got off to a very, very weak start and have done a little bit better. In the most recent data, we have seen some signs of life, but it's pretty rough in the trailer market. It's the trailer manufacturers have been reducing production pretty sharply in the past several months. It's been not the best story, in part because a lot of the capital that is available, which isn't too much right now at this point in the cycle, is going towards the power units because there's a lot of planning ahead of these 2027 regulations, which generally the industry still expects to go forward.
Yeah, that's why I was asking about those, is I think that regulations can have an impact on power units, but maybe not as much on trailers. And so I'm curious your thoughts. Are trailers a better indicator because they take that noise out of like true supply? Or?
Well, I think overall trailers are getting squeezed right now. So it's tough because the capital is being allocated more towards tractors, which isn't great news for the for-hire cycle. It's going to keep the market at this sort of dynamic equilibrium for longer on the for-hire side. And it's not great for trailer fleets as well, because it means we're probably not going to get to high single-digit kind of contract rates for quite some time.
Tim, talk more about the equipment type. You talked about private fleets and vocational trucks. So am I right in thinking they're mostly day cabs?
We have seen a good amount of day cab orders, and day cabs are taking some gain some share within the production mix over the past few years, as have vocational tractors, and sleepers are cycling down at the moment. That's definitely happening. And there has been, it's important to point out, even though we're still expecting the industry to add some capacity, Class 8 tractor build rates have come down. Tractors and sleepers and day cabs have come down a good bit over the past several months. And that should, that is positive for rates and should help the cycle to move forward.
Yeah, where I live here in Boston, I see a lot of day cabs coming out of Allentown and Harrisburg doing, with lift gates, doing multi-stop loads on sort of a 12-hour turn, maybe 11-hour turn, depending on the radius of operation. So you see a disproportionate number of trucks doing that overnight e-commerce fulfillment role, and also that regional, distribution center to retail store move. What got my attention last week, from a driver perspective, it's one of the hardest schedules to run, is any schedule where you're up at 1 or 2 in the morning and have to be unloading early in the morning on a, anything like a 600-mile round trip in a day cab where you can't sleep. What got my attention was last Friday, I-95 was shut down with the trailer that rolled over just about noon, sort of, after being awake for about 9 or 10 hours, the driver went too fast into an exit and put the trailer over and shut down I-95. Of course, the truck had biohazards and placards over the entire back of the trailer. It's the worst possible combination. But it just struck me that I see a lot more, and I can't quantify it, but I see a lot more shippers and private fleets doing day cab work that really is stretching the limit of utilization levels, where you control the unloading and loading, and that's a critical piece. But the risk side of it is substantial when you get into this day cab world, where we've now got a lot more warehouses much closer to population. So I think there's a connection between it. I'm not sure how you quantify it, though. Any thoughts on how we might think about that?
Yeah, no, it's a great question. To put some numbers around, I mean, day cabs are somewhat synonymous with private fleets as we look at the numbers, and I think they've gained about 2 percentage points of say, share of Class 8 sales in recent years. To put a couple just broad parameters around it. So it's obviously not only private fleets who are buying day cabs, but I think your point is exactly right, that this is showing some of the limits and how the insourcing trend has been stretched to its limits and past it in a lot of cases. And you can see that just from a cost perspective as well. I do love the rate differential, Chad. You're showing between spot and contract is fascinating. We also love to consider private fleet costs, which are well above spot or contract at the moment. Yeah. If you look at the NPTC's annual study that had last year's private fleet costs of like $360 something a mile, and some of that premium is it's built in because it's a shorter length of haul, but it's like twice the normal level right now, that the spread between private fleet costs and contract rates. And so that I find really interesting as well. It's some of this is a big post-pandemic reaction of after having lost some control of supply chains. Shippers really wanted to regain that control, but it's clearly it's very costly and dangerous in a lot of cases, as you described, and inefficient. And so we do think fundamentally it does have to come back to the for-hire market eventually.
Very interesting. We heard that at DATCon. I think, Chad, if you recall some of the conversations, and then post DATCon, some of our brokers were talking to shippers about accessing, day cab trucks on our load board, like being very specific about day cabs for a particular route they wanted to run.
Right.
Because in the spot market, I think that's incredibly problematic. Because to run dedicated work, you've got to control the load unload points with ELDs. So you've got to be turning and burning, to use a driver phrase. You can't be wasting time on a loading dock, which I guarantee is what's going to happen in the spot market if you have different drivers hauling different loads in and out. So in theory, day cabs work, but you've really got to have quick turns on either end for it to be viable.
Yeah, or slip seating. Yeah.
Tim, what other sort of macroeconomic factors are you looking at? So maybe let's start with interest rates. That's one of the big ones. Lots of talk about trade wars, tariffs, inflationary effects there. What's your take on where interest rates go next year?
Yeah, good question. I think interest rates have been one of the most fascinating topics of the past month or so. We've been sort of not pleasantly surprised that the bond markets seem to be pricing in a lot of the inflationary policies that have been promised, and interest rates have gone up, even though the Fed has cut rates 75 basis points over the past few months, and we think it's most likely that they'll cut another 25 basis points here later this week. We think that's not really flowing through into the financial markets. The financial conditions have actually tightened a little bit as rates have gone up. Mortgage rates are not far off of their highs right now. So that's a little concerning, I guess is how I would describe that piece of it. And that's not good for freight generating sectors, which are capital intensive things like durable goods. It's not great for machinery and those types of things. And there are a number of project cancellations happening in some parts of the industrial sector that we're concerned about too. But overall, the industrial sector has been pretty resilient, and I think that most of that will remain. But there's definitely some speed bumps coming, I think, in that part of the freight world. But the consumer has actually done relatively well, and consumer trends have been steadily improving. We're still a little bit below long-term trends in terms of goods consumption, in terms of retail sales, but things are heading back towards those long-term trends, which that's good news.
So we have a tendency to spend well beyond our limits as a nation. Where do we sit with delinquency rates on, say, credit card spending?
That's a good question. I don't have that at the top of my mind, but what we were looking at as a firm the other day is just how much where U.S. household net worth is right now, which isn't something that we focus on too much, but we talk a lot about the debt, but this country has $168 trillion worth of household net worth, which is an all-time record, and has basically doubled over the past decade. And so the U.S. is very wealthy at the moment. I think that's a positive that it suggests that we can afford some leverage. I mean, certainly not all households can, but I think there's, and I'm not trying to get into the distribution of that, and obviously that's not even, but in general, the balance sheet of the economy is pretty strong.
On the macro side, can you speak to regulations? Can you remind us, you mentioned one from a pre-buy perspective, I think it was 2027 you mentioned. Can you remind us, what are the upcoming regulations that the industry has to face, and are any of them expected to change with the new administration in place?
Yeah, great question. I think there's two big ones that we got to be worried about. There's the Clean Truck Initiative, which kind of referred to as EPA 27. We're 5 years into that 7-year rulemaking process at this point. It's set to take effect January 1st, 2027. It will be costly, but it's mainly making some small changes to the diesel engine. The other one that is a bit bigger deal from an electrification standpoint, and pressing significant improvements in overall, GHG is called the GH3 regulation, and that one is really likely to be revised, we think, under the new administration, and probably was even likely before that because of some Supreme Court rulings last summer, and that seems like it's going to be really delayed. So anyone who's too concerned about some of the stuff that's going on in California, which is really pressing electrification really hard right now, that's not likely to happen at a national level. I mean, it was initially targeted for day cabs in 2028 and sleepers in 2030. But we think those dates are going to get pushed out probably. And so we don't have to worry too much about that. But the factors driving the pre-buy, which is important for the cycle today, we think that's going to go forward. That rule was made under the first Trump administration. It was like the only one that was. We think that it's an interesting debate to be had about whether or not it will be attacked, because it certainly could come under attack. It's hard to say, but it's not something. There's a lot of unknowns, or known unknowns right now, and this one's a big question mark. We have to keep watching.
So, Tim, if the dates get pushed back, do the percentages of the fleet that has to be zero EV change also, or is it just the dates you're thinking might get pushed back?
Probably the percentages too. Yeah, I think the dates get pushed back and the percentages get pushed down is roughly the the intention. And if you look at prior Republican administrations, they basically just haven't done anything. Is essentially they won't put anything in place. That is the most likely scenario.
But can you talk to some of the stuff we're seeing at a state level, right? So there's a lot of angst here in Massachusetts because some of the truck dealers can't sell diesel-powered trucks until they sell a battery-powered truck. There's some requirement there that they have to sell a certain percentage. Do you see that changing? Because that's causing a lot of carriers that want to buy new trucks to just shy away from new trucks completely.
Yeah, so that's exactly what I'm talking about, the GH3 rule. So that's California is essentially doing that in 2000. This year it went into effect there. And there's a few other states, but I think most of the other states that had tried to join California on this have realized that they don't have the infrastructure in place to do that right now, and they're pushing things back. And then they're also, I think, realizing that this is probably not going to happen at a national level at the same pace. And so I think most states who are trying to follow that California along that path, which is the path towards GH3, are hitting the brakes on that at the moment.
Got it. Okay, good. I didn't realize that was the connection. All right.
Is that, I assume that doesn't change for a major trucking company that's going to buy equipment. It just changes where they buy from. Is that the effect it has right now with different states with different regulations like this?
Yeah, exactly. We're talking about states that don't have a lot of big fleets, essentially.
Right.
But I mean, it's certainly disruptive in those states. Here in California, Class 8 sales are down something like 80% this year from last year's levels.
Wow.
Yeah.
Yeah. So if that's the business you're in, that's not good for you. So more of the sales are happening in states that don't have those regulations right now. Yeah.
So Tim, I was doing some research for a blog post ahead of my trip to Australia in February, and they've just started a project with Class 8 trucks running on about a 400-mile radius, grossing 150,000 pounds, with big batteries that solve, I think, the battery charging problem, as in the time it takes. And essentially what happens is the battery pack you forklift in and out of the side of the truck. So you have these stations strategically located where within 4 minutes you can swap your battery in and out, and then the recharging station just recharges the battery you pulled out. I don't understand why that's not part of the thinking here, because to me that seems like a game-changing idea.
Yeah, I think that's fascinating, and I think that is something that could solve a whole lot of problems. I think the first thing that sort of raises alarms in my head is that sounds expensive, but but if it can be done well and right, and the cost can be, I mean, that does seem like it's fascinating.
Yeah, they've got about 40 trucks running. It's Janice Electric that have done it. One of my old bosses have built the technology. And when you think about a lot of freight moves regionally, if you strategically place infrastructure at that 600-kilometre, 400-mile mark, it captures probably 85% of the freight task in Australia. So whether it's applicable here or not, I'm not sure. Certainly the long-haul task, that'd be very different. But just the idea that you don't have to plug in somewhere and just have a forklift drop a big battery pack in and out, to me, that's like really clever thinking. So
how does that 4 minutes compare to filling a diesel tank?
2 tanks, probably 15 minutes by the time you walk in and out, pre-approve your credit card if you haven't got a fleet card. So I think it's quicker.
Yeah.
So, I mean, someone's going to solve this problem. And to me, that was one of the solutions that I thought just popped up this week.
That's super interesting.
Yeah. Tim, as always, we love having you on. You're the last guest on the show, so you get the last say about what next year is going to look like. So what's your summary? What do you think we should be thinking about next year?
Well, I do think we're getting towards the end of this downturn. I do think next year is going to be interesting. I think it's fair to say we've moved into a positive sort of phase of the freight cycle. I think we should keep expectations relatively reasonable and rational, and not think that things are going to take off in too big of a way. But there are some upside risks to the cycle, and there are I think there's more upside than downside at the moment, and I think next year is going to be a bit better year. How about that?
Good. Chad, what do you think?
Yeah, I think we're kind of in that equilibrium phase right now, and I think we're pulling upwards out of it slowly. That based on the data we see from that new rate differential and what shippers are getting back from their bids, and when we survey shippers what they're expecting next year, they've been working through their large annual RFPs over the last couple of months, and those will start to roll out and execute into Q1, early Q2. So it's a long process. So they've got a little bit of insight into what those future contract rates will look like. So if I had to guess, I'd say 1% to 2% contract rate increase in the first half of the year, and then maybe pushing 3-4% in the back half of the year, and maybe spot rates up as much as could be 20% during some seasonal spikes. I think the produce season, the spring season, March, April, May is going to be really telling to see how the market responds to that tightening of increased demand. So exciting to watch it and see how it progresses.
Yeah, I think the first quarter is going to be tough. We borrowed a little bit of freight volume on the import side from next quarter into this quarter, so I think that's going to cause a little bit sharper contraction in demand in the spot market for carriers. But I also think this has been a pretty brutal year. Carriers are ending the year slightly in the black, but much the same as where they were in 2019, which was a losing proposition over the course of the year. I think softer to maybe slower demand in the first quarter is going to cause another exodus of carriers in the spot market. I just think 12/31 is a common insurance renewal date for a lot of carriers. I think a lot of carriers that have been on the edge may find the going pretty tough in the first quarter. So that might trigger a sharp correction in spot rates. I'm not sure. I just think the first 3 months are going to be harder than most. It's always a quiet season, but I think this one's going to be a little bit quieter than most. All right. That brings us to the end of the show. Tim, how can people get in contact with you?
Oh, you can always find us at actresearch.net. And yeah, thanks for having me. It's been great to be with you.
Yeah, love having you on, Tim. A couple of shout outs on this week's Freightvine podcast. Professor Kaplis is talking to Rob Haddock, former Coca-Cola executive, where amongst other things, they discuss how Rob believes artificial intelligence is akin to Iron Man's AI suit Jarvis, in that it can make an executive or manager better and smarter at their job, not as a replacement. It's a really good listen. This is our last show for 2024. Thank you all for watching. We'll see you back here on January 7 next year. Make sure you set up alerts for our live show, subscribe to our channel. With that, another show's in the books. Be safe, be nice to everyone. We'll see you back here on January 7 at 10 a.m. Eastern, 7 a.m. Pacific.